Welcome to Always Ageless, the show where we celebrate living well and aging wisely and making confident choices at every stage of your life. I'm your host, Valerie Van de Zilver, and today we're diving into a topic that's often misunderstood. So hold on, because it's incredibly powerful when it's used correctly, and that's reverse mortgages. Now hold on, don't make a judgment, and before you change the dial, stay with me. This isn't a sales pitch. This is education. Whether you think it's something you might never even want to know about or use, isn't it better to know from a point of education than from hearing it from somebody who doesn't know what they're talking about? So if you're a senior looking at options for your future, or you're an adult child of an aging parent trying to help your parents or a loved one navigate theirs, we believe that informed decisions lead to empowered lives. So joining us is someone who doesn't just know the industry, he's helped shape it in many ways. Michael Pankow is the reverse mortgage specialist with over 20 years in the mortgage business. He's also, Michael, I think, the CEO of Veterans Mortgage of America. He is a proud U.S. Army veteran and a passionate advocate for both seniors and the families who love them, those of us. This conversation is going to shed light on what reverse mortgages really are. So you're going to hear the truth from the person who knows it and who the reverse mortgage might help and how they can be a bigger part of your plan when you're planning as a senior, for your peace of mind, financial dignity, and for freedom. So let's get started. If you're driving, roll up the window and turn up your radio. If you're home, grab a cup of tea or a glass of wine, and let's meet Michael Pankow. Michael, welcome to Always Ageless with Valerie V.
Thank you, Valerie. I'm honored to be here, and that was a great introduction, and I'm glad we have that recorded. I'm going to use that again.
Okay, well, that's great. Michael, you've spent over 20 years in the mortgage industry, much of it focusing on reverse mortgages. So what drew you to this field and what's kept you passionate about it for so long?
What initially drew me to the field was when I was a junior in high school, my grandfather took a fall, ended up in the VA hospital, broke his hip. And for that summer, when he didn't make it out of the intensive care, I drove my grandmother back and forth from the VA hospital in San Diego up to her home in San Marcos. I spent the entire summer doing that. And my grandmother and I were very close. So I watched her, even though financially they were okay, but I watched her go through the trials and tribulations of aging in place, being alone, having seen my grandfather went through what he went through, and then he did not make it out of the hospital. I've always been very close to and liked serving seniors. And then when I got in the mortgage industry, back in 2004, somebody introduced me to the reverse mortgage field, and I thought, wow, this is kind of cool. And I saw how powerful it could be. So my mom and dad have got a reverse mortgage. My business partner's got a reverse mortgage. And of course, lots of other people that I've worked with have got reverse mortgages. But anybody that I really care about, I try and educate them. And I like how you said this is about education. This is not a sales pitch. This is about educating your listeners and the people that I work with about truly what is a reverse mortgage and what are the consumer protections for them and their families, right? That's another big part of your show here, which is how we educate the family members about the resources and the services available to mom and dad if in fact they don't have those resources. So I love the fact that we're basing this on education and not a sales pitch.
Well, and we might just take a little side direction here and mention that I have this show because I used to be the guest on a show called The Educated Retirement. And the host for years was a man named Jay Kaplan, who was a specialist in the mortgage industry also for years. And Jay had a show that focused on reverse mortgages. I was a guest of his many, many, many times. And when Jay passed away, my first question was, can I follow in his footsteps and have a show? So I didn't take his name, but I am certainly a protege, and I'm very proud of all the things he learned. And Jay always said, Valerie, everybody should have a reverse mortgage. And I don't need one. I don't need one. Well, of course, the older I get, and the more I see it in place, and the more opportunities there are for people to use it, then the more I believe that. So we want to talk about a little bit more about your background. You served our country as both a commissioned and non-commissioned officer in the U.S. Army. How did and thank you for your service. And your son is also or was in the military in the Marines, I think. Is that correct?
Yep,
Yep.
was a U.S. Marine, and now he's a lineman in South Carolina. So now I'm actually more worried about him now because he's dealing with high power electrical lines every single day. But
Yeah,
yes,
yeah, well, you were probably more familiar with the service side of it, so you're a little bit more comfortable because you knew what he was dealing with. So
that's
tell
right.
us, how did your military experience shape your approach to helping veterans and seniors today?
Well, came from a very patriotic family. Father was a helicopter pilot in the Vietnam War, and he flew for over 30 years. And then my grandfather on his side was at Iwo Jima, Saipan, and Okinawa as a Marine infantry guy. And so I just grew up around it, right? And love John Wayne movies, love all of that. And my theme is my whole thing is hate war, but love the American soldier, right? Hate war, but love the American soldier. And so we founded the company Veterans Mortgage of America. The four of us that founded it are all veterans, 100%. And we recruit a lot of veterans. We actually won an award from the U.S. Department of Labor, which is the Gold Medallion for small company size for hiring and retaining veterans, which is great. And we're growing every day. We're recruiting new people, and so we're excited about that. But there's when you our philosophy at Veterans Mortgage of America is that their service was their down payment, right? That was their down
Yep.
payment.
Yeah.
So the VA loan is 100% loan to value. They don't have to come up with their down payment because they already did that when they served our country in defense of our nation. So we feel very strongly about that. And what I love about what I'm doing now as a CEO and co-founder is that with the reverse mortgages, there's a lot of veterans who are now in their late 60s, 70s, and 80s. And a lot of those guys and gals, they maybe some of them have a military retirement, some of them don't, or they're on a fixed income. And so it's a great opportunity for our aging veteran population who are on a fixed income, maybe cash poor, but house rich, as we say in the industry, and get them the opportunity to breathe a little bit of life back into their future.
So let's go back and start from the beginning on our reverse mortgage section here. So give us some statistics about seniors and who would use it. What part of the population are we talking about for reverse mortgages?
Yeah. Well, just some basic qualifications, but there's 12,000 seniors a day turning 65 and above.
That's
12,000 a
impressive.
day.
That's amazing, isn't it?
It is not a month, not a year, but that's a day. So by 2030, all
Just in the
baby
United
boomers,
States?
just in the United States. That's right. Just the United States. So by 2030, 100% of the baby boomers will be 65 and above. So that means that all 100% of the baby boomers will qualify in terms of age, which is 62 and above, for a reverse mortgage. The other stat that's important too is that people are living longer now, right?
Yeah.
They're living longer. So the chances for longevity risk, where they're outliving their money and their funds, that's greatly increasing. And oh, by the way, 90% of all seniors want to age in place, meaning they want to stay in their home before they move on to a different lifestyle. And so a reverse mortgage in many cases can help them by freeing up cash, whether we pay off the mortgage or we provide them with a line of credit.
We have already said, and I'll say it again, and I might say it again while we're on this show together, is a reverse mortgage is a vastly misunderstood product. And I think they must have been different several years ago because the language was so bad. And I still hear people say, oh, it's a terrible thing. It's a big scam. The government's going to take your house. And we're going to talk about those things. But just take a minute and start us from the basics. What is a reverse mortgage? It doesn't even sound like a nice thing. A reverse mortgage, what does that mean?
Right. So what I like to start with is a reverse mortgage is a sustainable solution. And I say that because of the consumer rights and protections that are in place that we'll talk about a little bit later as we go through this. But a reverse mortgage in its very simplest form allows a senior to gain access to the equity in their property tax-free without ever having to make a payment until they decide to pay off the mortgage. So let me say that one more time. Allows the senior borrower, age 62 and above, to get access to the equity in their property tax-free without ever having to make a payment until they decide to A, pay off the loan, meaning they get a refinance or they sell the property. B, God forbid, there's a maturity event where that senior no longer can remain in the property and they have to move to a full-time care community, or they pass and then the heirs have the opportunity to do what they're going to do with the property, which we're also going to cover later on as well.
So there are certain things that have to happen, though. They have to be at least, is it 62 and a half? Is that the age?
62, just 62 and above.
Okay. And can that be for either spouse?
So so one of the borrowers, so let's say you have a married couple, okay? And they don't have to be married, by the way. But if you have somebody who's living in a home, it's got to be their owner occupied residence. So that one of them has to be 62 and above. And let's take a couple. Let's take a married couple. Let's say the usually it's the wife, she's younger, and which is, oh, by the way, why this is in place. But if the wife is 56 and the gentleman is 66, well, there's a 10-year gap. Okay, well, they're going to base the reverse mortgage on the age of the younger spouse because you have one member of the family that's above 62, but the younger spouse, for life expectancy purposes, they're going to do all the calculations based on the younger age, whether it's a man or a woman. Okay, so that becomes what's an eligible non-borrowing spouse, which means that as long as they meet the terms of the loan at the time they get the reverse, during the reverse, and after the reverse, okay, and after that most senior borrower passes or moves into a full-time care community, that's what happens. That younger spouse, as an eligible non-borrowing spouse, gets to stay in that property in perpetuity until 150 years of age.
But will they have been on the loan?
Yes, as an eligible non-borrowing spouse, they will be on the loan. They will be on the loan, but they're not the primary. The primary is the person who's 62 and above. Now, if they're both 62 and above,
Sure.
then they're both on the loan and all of the rights and protections apply.
So let's make sure our listeners and our viewers are very clear on this. So the minimum age to even think about a reverse mortgage is 62. And if
Yes.
you are married to someone who's less than that, they may be a non-borrowing spouse, but of course, depending on all the other qualifications, they may qualify. They may be able to be a part of that loan and that mortgage situation.
Yes, they'd be an eligible non-borrowing spouse. Now, just to be clear, the age limit of 62 and above, that's for an FHA reverse mortgage. Okay, that's for an FHA reverse mortgage. In some states, we can do proprietary reverse mortgages, like in the state of California. We can do a proprietary, and that starts at the age of 55 in most states. But 98% of all the loans that occur on the reverse mortgages are FHA. And so I'd like to stick with the FHA today.
Sure. Okay. Well, and of course, the thing that's a little ironic here is that you and I talk often in our groups that we don't think that if you're 55, you're old. But
Right.
so, there's a little, irony here. So one is for the reverse mortgages, but that doesn't mean that just because you're that age that you're old. So we just want to get that cleared out here.
That's right. Because I'm 58.
Okay. Well, I'm much older than that. So, okay. All right.
Right.
So when you say it's a sustainable solution, what does that mean?
Well, so we had talked a little bit about this before the show. A reverse mortgage is a non-recourse loan. Well, what does that mean?
What
Right.
does that mean?
Well, what does a non-recourse loan mean? That means is that you as the borrower or the heirs, your kids, heirs, whoever you name as an heir, are never responsible to pay back the reverse mortgage if the reverse mortgage balance exceeds the value of the home. So let's say you're an early adopter, and everybody knows Tom Selleck has been pushing reverse mortgages for a long time. Look at that smile. See, you know Tom Selleck.
Absolutely.
And right. Well, if you got a reverse mortgage 15 or 20 years ago, that reverse mortgage, because again, it works in reverse. You don't make a payment on a reverse mortgage. The interest adds up over the years. That's how the bank makes their money. So instead of you making a monthly mortgage payment like a traditional mortgage, you don't have to make a payment and that interest adds up. It's called deferred interest. All right. Well, let's say you had a reverse mortgage for 20 years. Well, that reverse mortgage balance may be 2 or 3 times higher than what you started at when you first got it 20 or 25 years ago. Well, let's say we had an event like in 2007 or 8 when the mortgage property values declined greatly. Okay. And let's say there's a maturity event, which means you either pay it off or you pass or you move into a full-time care community. Well, at that point in time, the loan would be due. And if the value of the property is less than the actual reverse mortgage, you think, uh-oh, who's going to cover the difference? So let's say, for example, the reverse mortgage balance is $300,000. Okay. But let's say the value of your property is only $200,000. Well, if I sell it, I owe $100,000. But no, you don't. With a non-recourse loan, the maximum that you or your heirs would pay back is the $200,000, which is what you're able to sell the property for. You're never responsible for the difference.
And what happens if you are the non-borrowing spouse?
Same thing applies to you. Same thing applies if you decide to sell it. You would never have to pay for the difference. So the reason why that is because one of the consumer protections in place is when, and this goes into one of the myths or questions, reverse mortgages are expensive. Yes and no. There's a 2% upfront mortgage insurance that is charged on every single reverse mortgage. Okay. That 2%, which is times the value of the property or the sales price, goes into the kitty with FHA. That kitty is dipped into when a home is the value is less than the actual reverse mortgage balance. That's why the heirs or the borrower never have to pay that difference. That's why it's called a non-recourse loan. The property pays back the reverse mortgage, not the borrower.
So it's kind of like operating as an insurance company, right? You can afford to pay out insurance claims because you've got hundreds of millions of people every day that are paying insurance premiums that don't use them. That when somebody has a fire, then the insurance company has money to pay that. So it's the same thing here. So let's give people an example. So let's say, and let's use a round number. Let's say in California, we're 500. There's Northern California, you can get loans for 500. Southern California, there aren't very many of them, but let's use 500,000. So someone has a $500,000 loan when they start with. And let's don't talk yet about down payments. We'll get to that in just a minute. So someone has a $500,000 loan and they took it out 5 years ago, a reverse mortgage, and they haven't been making any payments on it. Right?
Okay.
But they are paying their insurance and their taxes.
Right,
and
which is a
homeowners
requirement.
association, if those exist, correct. So now we're 10 years later, and probably their loan could be what, 550 or 600?
Yeah, so I'll just give you an example here. So, I'm looking down because I'm looking at my phone. I'm plugging some numbers in for you. So let's take 800,000 value of property. Okay, and let's say they started with a balance of 100,000. Okay, and let's say they are 72 years of age. Okay, 72 years of age. They have a property that's worth 800,000. And the existing mortgages that they're paying off is 100,000. That's where their loan balance would start. So if we want to look at the amortization schedule, let's go 5 years down the road, which means they're 77. On that loan that qualified for a line of credit, and I didn't want to confuse everybody, but there's a line of credit, which we'll come back to. That loan, if they just kept the balance and they started with the balance of 100,000, they'd owe, after 5 years, $171,000 on that loan. Okay, if they didn't use any of the line of credit. 10 years, if they didn't use any of the line of credit, they would owe $241,000. But during that 5 and 10 year period of time, what's important to remember is that we have home values appreciating.
Right.
So HUD says that the average appreciation per year on an average, since they've been keeping track of it, is about 4%. So at the 5 year mark, they'd owe, like I said, 171,000. But the home value went from 800,000 in that 5 years to about 973,000. So they still have lots of equity.
There you go. Sure.
Right?
Sure.
Same thing if they are now 82, which is 10 years later, they owe 241,000, but now the property value is 1.184 million.
Sure.
So lots of equity, right? But what I didn't share with you is, because I didn't want to confuse the issue, is that, getting a reverse mortgage is all about your age. It's about the value of your property, and it's about where the interest rates are at the time. So in this particular deal here, we had 800,000, they owed 100,000, their age was 72, and based on the interest rate, it calculated that they would have a line of credit after paying off the $100,000 mortgage that they had of $197,000. Now, what's beautiful about that line of credit, that is a lifeline for a lot of people. Not only did they save the monthly mortgage payment by paying off the $100,000 mortgage, but they also got a line of credit. And with a variable rate reverse mortgage, you can use that line of credit for whatever you want. There's no restrictions. So you can use it for lifestyle needs. You want to go take a vacation. You want to gift the money to your children and watch them enjoy it. You can sit on that money and not do anything with it and let it grow. And by the way, the line of credit grows as well. You can make home modifications for the aging in place conversation we had earlier, right? Where you can make home modifications, everything, and that's whatever you want to do. Or you can use it as a part of the plan. A lot of people will get a reverse mortgage instead of dipping into their Social Security at the age of 62. They'll delay and they'll use their line of credit to fill the gap until they're 67 or 70 because they think they're going to live a long time. to fill that gap so they don't have to start drawing on their Social Security. So you can use a reverse mortgage line of credit, for anything that you want to use it for. Anything. There's no restrictions. And it's not counted as income. It's not taxed.
Well, that's a good deal.
That's a great deal. And guess what? Unlike a HELOC, most of us know what a home equity line of credit is.
Right.
That line of credit that I just talked about is incredibly protected. No one can touch it. They can never pull it away from you. They can never reduce it. The value of your home could go to zero, but that line of credit is left intact. And it goes up every single year at whatever the prevailing interest rates are. So going back to that same example, I didn't get into this, but the line of credit that started at 197,000, if they were doing fine, didn't want to touch it, well, if we go to age 77, that same line of credit now is 277,000. So it went up, and you never have to make a payment on it. So you can use it. You can take it out in monthly payments. You could take it out in what they call distributions. You make a phone call. You can access that money however you want to. The only restrictions they put on it is year one, they give you access to about 60%. But you never have to make a payment on it, ever, 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 until you sell off that loan, till you sell the house, until the kids get it. And then that's when that is paid off.
So we've established that it's a non-recourse loan, which is great, because I think a lot of people believe, I think one of the common misconceptions, and you can tell me whether you hear this also, is that people think they have to pay it back, right? Or that when they sell the house, they have to pay it back, and the government owns their home. And so the fact that we know now that it doesn't have to be paid back is just a great thing. So let's
the amount that you owe has to be paid back, but it's only up to the value of the property.
Right.
So you have to pay back the reverse, but just up to the value of the property. Just want to make sure.
Right. Yes, that's my mistake. That's true.
That's okay.
So let's talk about what are some of the minimum qualifications. What are some of the basic qualifications? We've told our listeners and our viewers about the age has to be 62, but how else? Who qualifies, and what do the lenders look for?
Yeah. So 62 and above, it's got to be your owner occupied residence, meaning it can't be a second home. It can't be an investment property. Now, can you own your home, live in your home, and then rent out a room? Yeah, you can do that. But as long as it's where you live, where your primary residence is, that's a minimum qualification. You also have to go through HUD counseling. You have to go through HUD counseling. It's a phone call. It's anywhere between 45 minutes to 2 hours long. Costs about $150, depending on which counselor you get a hold of. And that's also a consumer protection. So that's number 3. Last but not least, there's a financial assessment that's brought into play. And the financial assessment is there to protect the senior. And what that involves is looking at what are their debts on their credit report. It's not a FICO score driven program. We don't look at your FICO score. What debts do they have in the credit report, the minimum payments? What is their taxes, insurance, and HOA? And what's their living expenses look like? And that's a calculation based on the size of the property. If they can cover all of those after they get the reverse mortgage with their current income, and also looking at the line of credit, which we can use the line of credit to help mitigate some of that, then they qualify. So again, it's 62 and above, owner occupied. They got to go through HUD approved counseling. That's a minimum requirement, and they got to get through the financial assessment. And the financial assessment is important because back in the 80s, there was a lot of bad actors, and the financial assessment piece wasn't as robust as it is now. And the classic story of a reverse mortgage is that there's a woman or a man on the porch. The news reporter shows up and says, "Hey, why are you losing your house today?" "Well, I have a reverse mortgage." Well, we know already that that's not the case. And what happened is that the financial assessment wasn't demonstrating that they continue to pay their taxes, and their insurance, and their HOA. And you know that if you own a property free and clear, or if you have a forward mortgage and you don't pay your property taxes, the county, after a period of time, can come in and take the property. And that's the kinds of things that were happening.
But that wouldn't have happened. It wouldn't have changed whether they had a reverse mortgage or not. You still have to pay your property taxes, right?
That's right. You still got to pay them no matter what. That's right.
Okay. All right. So let's talk about this. So we know you have to be 62. So let's say I'm 65 or I'm 75. What difference does my age make when I'm qualifying for a reverse mortgage? Does it make any difference at all?
It makes a huge difference, right?
Okay,
Huge
so
difference.
what is that?
So as you get older, your life expectancy based on life insurance tables is shortened. So if you're 72 and your life expectancy is forecasted to be 82, well, you only have 10 years left. So the chances that
that would be sad in my case, but go ahead.
That would be sad, right? That would be sad. So the chances that you're going to be in the reverse mortgage and your loan balance is going to exceed the value of your property are very small, right? Very small. So the older you get, the more access to the equity you get. The younger you are, meaning 62, right? The younger you are when you get that reverse mortgage, the smaller amount of access to your equity because they're expecting you to live longer. So the chances are is that if you live to your 90 and you've got a reverse mortgage for 28 years, your loan balance may possibly exceed the value of your property, right? So they give you less access to your equity the younger you are. Like I'm doing a reverse mortgage for a gal that's actually in Los Angeles. She's 88 years of age, and they're giving her close to 70% access to her equity because, she's 88 and she may not live for another 10 years. So the older you are, the greater access to your equity you have. The younger you are, the less access to your equity that you have.
Okay, so I'm 65, and let's talk about the $500,000 loan amount again. So let's say my house is worth $750,000. So I'm 65, and all other things being equal with my financial assessment and everything, my qualifications financially. So how much am I likely to be able to borrow?
Well, let me ask you this. Do you own your home free and clear? Which is not a requirement, but that helps.
No, I have a loan I'd have to pay off.
Okay. So if you're let's say your loan balance is fictionally 250,000. Okay. I don't know how much your loan balance is. And what is your age again? 65?
Let's just say I'm 65.
Okay, 65. So in that case, at $250,000 we have to pay off, we'd be just at a break even, meaning we'd be able to pay off your $250,000 mortgage. You no longer have a payment, but you wouldn't have a line of credit. Okay. So
you're
we'd
saying
stop the bleeding.
So it would be about 50%?
And based on that scenario, the age, based on the interest rate, the margin, all of that, yes, it's about 50% in that scenario. Now, if I slid this, let's put it age 75, okay, that's 10 years.
All right.
Right, this will demonstrate that. Now, not only could we pay off the 250,000, but you would get more access to your equity. You'd get a line of credit for $48,500.
So then if all I was going to do is break even, I'm going to pay off my $250,000 mortgage, and FHA is going to loan me $250,000 as a reverse mortgage. So why would anybody do that when it doesn't make any difference? You still are going to owe the same.
Well, because on that money that the reverse mortgage, that 250,000, you don't have to make a payment. So if you're making it, right?
Okay.
Right?
Viewers and listeners, listen to this. So
Right.
you're currently in a house, you have a $250,000 mortgage. You can't afford to make that house payment anymore for whatever reason. Your spouse died, your roommate left you, you lost your main source of income, you still have Social Security or whatever, but you can't afford to make that house payment. But now you can switch that $250,000 mortgage to a $250,000 reverse mortgage. And Michael, tell us.
You no longer have a payment on that house. So whatever money you have coming in on a fixed income, whatever that mortgage payment was, whether it was $1,000 a month or $1,500 a month, you put that right back in your pocket now.
So here is one of the myths and one of the things that hurts me so much, that when I see people where a spouse passes away, and you just talked about it, someone on the porch, a spouse passes away or something happens and someone is left alone, a real estate agent comes in and says, you need to sell your house. You can't afford to make a payment anymore. You need to sell your house. But a senior specialist who really has passion for caring for seniors and making sure that they get what's good for them might suggest a reverse mortgage, and that person could help me, Michael, if I'm right or wrong, and that person could stay in their home.
Yep.
Correct?
Yes.
Get rid of that mortgage payment. They still have to pay taxes and insurance. And if they have an HOA, get rid of that mortgage payment, and they could stay in their house and nobody ever told them that.
That's right. That's right. And save that monthly payment, which to somebody who's on a fixed income of $2,000 to $2,200 to $2,500 a month, that's a lot. That's a game changer. Now you're not thinking about when you turn on the AC and what food you're eating. Now you've got a little bit of freedom, right? You just got back tax-free, $1,200 or $1,300 a month, tax-free,
Right,
because you no longer have to make that mortgage payment,
right, right.
right?
And that is game-changing, life-saving.
Mhm.
Because if you are, Michael, we helped a family about a year ago. They couldn't afford the house. The husband was disabled, couldn't work any longer. So they couldn't afford to make a mortgage payment anymore. They could not. So they
Right.
could move, they could sell their house and then they could move and they could rent. But if they rent, they have increasing rent payments over time.
Mhm.
They have no control over the rent or the property they live in or the condition or so forth. And if the rent gets raised, they're just stuck. And they weren't, it's not like they were on their deathbed, you know, they were probably in their 70s. So they had a long time that they still could live.
Yeah.
So they could go and rent. Someone could sell their house and say, okay, we'll go find a rental. But then when that money's gone, that money's gone.
That's right.
Or,
And they still have to find a place to live.
and they still have to find a place to live. Or they could buy something with a reverse mortgage, have no
Mhm.
house payment, and if the
Mhm.
house goes up in value, they not only benefit by having no house payments, but they benefit because they get the appreciation.
That's right. That's right. So you're talking about a reverse mortgage for purchase. And one thing I'd like to point out before we get into that, I've seen a lot of seniors and I've refinanced them out of a HELOC, the home equity line of credit. And one thing I'll say about that, that's a Band-Aid. And the danger with a home equity line of credit, there's two things. Is it A, you have to make a payment on that, so your cash flow goes down. B, they can pull that line of credit back anytime the bank wants to. So there's no guarantee that you get it today that you're going to have it 2 years from now. If the economy goes the wrong direction, or if you have a hiccup in your FICO score, or you don't make a payment, they can pull that home equity line of credit from you. With a reverse mortgage line of credit, it is yours. It is protected. The value of the house could go to zero and your line of credit is intact and you never have to make a payment on it. So that's really a powerful piece, a lot of security for a senior. Now, a reverse mortgage for purchase that you just mentioned. So, matter of fact, my
And
very
I know I
first
kind of
reverse
got off the
mortgage.
subject a little bit by going to that, but
No, that's okay. No, it's a great example when you said downsizing, right? So a lot of seniors will say, well, I'm going to sell this house. I'm going to take all the equity. I'm going to pay cash for my next home. Okay. Okay, that's great. That's great. But guess what? Why don't we save a little bit of money, buy up, and not spend all your money, right? And still achieve all the same. You're on title, just like you paid cash, but you never have a mortgage payment, and you're going to pay taxes, insurance, and HOA anyway if you have an HOA. So here's what this looks like. Same kind of principles apply. It's sales price, borrower's age, and the interest rate. Okay. So if we said, what's a typical home purchase price there in your area for a senior who wants to get, aging in place, single story,
800, 900,000. But they can
800.
go into the Inland Empire and buy something for 300,000.
Well, if you're downsizing, right, let's put the 300,000 in there.
All
Okay.
right, let's do that.
Okay. So let's say probably the average age of downsizing would be somewhere in that 75 to 78 years of age, probably. So I'll go with 75. So if you're going to do a purchase on a $300,000 house, that'd be $183,000 out of your pocket. That's your down payment. But if you're selling a house for 800,000 and you own it almost free and clear, or you have a $250,000 loan, you just saved a bunch of money that you can put in the bank.
So, Michael, in this scenario, is it true that I could, let's say I'm going to Arizona
Yeah.
and I'm going to buy something. And in fact, I just happened to look at one for another client today. So I know about this, something in the
Okay.
Tucson area or Phoenix even for $300,000. All right.
Yep.
And I'm going to buy it
Mhm.
on a reverse purchase. So I could then, um, so I could put down only half of, instead of paying cash, I could go pay
Mhm.
cash because I've got enough equity. I just sold my house here
Right.
in California. So I've got 500,000. I could go there and I could pay cash for it. But then all
Yep.
that money's gone.
It's gone.
That's
You'd
gone.
have to either
It's
you'd
gone.
either have to do a reverse to get it out, or you'd have to do some kind of loan to get the money out. That's right.
Right. And you have to hope that if you could qualify for another loan, that you could qualify. In this case, your qualifying is much easier. So
Yeah.
instead of buying the house cash, you're going to put down only $150,000. You're going to
183. 183 in this case.
yeah, depending on my age.
Right.
Right.
Depending on your age.
depending on my age. And I'm much younger. I'm older than I look, so let's just pretend I'm younger. Okay, and
Okay.
so we're going to put down $150,000. We're going to have no mortgage payment. We're going to have $150,000 more than we would have if we paid cash. And the
That's right.
difference is that someone didn't tell you that that was possible,
That's right.
that someone didn't know. And so they sold you a house for cash without ever telling you that you could have bought that same house with no mortgage payments with only 50% of that amount down. And
That's
that
right.
is why it matters who you work with. And I'm going to say it 100 times. This is what people who are aging need to know.
Agreed. Agreed. And here's a great opportunity with the reverse for
Let me
purchase
just
as well.
pound my bandwagon here.
Oh, for sure. Well, it's a great opportunity to buy up. So let's take that same 75-year-old borrower, and let's say that they wanted to buy a $400,000 home in Arizona. And we know that the difference between 300,000 and 400,000 in terms of neighborhood, quality of the home, all of that could be a game changer, right?
Could be
Well,
much nicer home.
could be much nicer. Well, guess what? They don't have to come in with an additional $100,000 for like because they went from 300,000 to 400,000. Their down payment would be 243,000.
Right.
So they can substantially buy up for a fraction of the money and get
Right.
a much nicer property
Right.
and still have money in their pocket.
Right. 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 So somebody's listening to us, Michael, and they're saying, yeah. Right. This sounds too good to be true. And probably if the government's got their fingers in it, it's probably a crooked deal. Right.
Mhm.
But the truth of the matter is, it is not too good to be true. If you are in a situation where you have nowhere to go and you don't have a lot of money and you are in the last amount of money you're going to get, why not buy something with no mortgage payments?
That's right. Yeah, that's right. Because you never know when you're going to need those additional funds, as you know.
Absolutely. Absolutely. So let's go to talking about the myths versus
Yeah.
facts. Okay, you have a
Okay.
few of those. Tell us, what are some of the myths versus the facts on reverse mortgages?
Right. So one of the big ones is that everybody's fearful of losing title or ownership of their property. With a reverse mortgage, you remain on title. The bank is not on title. They do not own the property. You are on title just like if you paid cash for the property or if you had a traditional mortgage on it. So you remain on title. That's number one.
Okay. All right. I hear this all the time. People say, yes, but with a reverse mortgage, the government is going to take my house. The government owns my house. Tell me, Michael, is that true?
That is not true. So what happens, and you know what's great about reverse mortgages, it's not only just the borrower that I'm usually talking to. When I'm sitting down, oftentimes, whether it's on a Zoom call like this, or if we are sitting at the kitchen table, I've got family members there and they want to know what happens when, God forbid, something happens to mom or dad. Well, here's what happens is that the kids or the heirs, number one, the non-recourse feature, which means you never pay more back on the reverse mortgage than the value of the house. Okay. So you're never going to owe money that you can't cover with the value of the property if you sell it. But the kids have got four options. The kids can buy the house for the amount of the reverse mortgage. Okay. Or the value, whichever is less. They can refinance onto the reverse mortgage, meaning they pay off the reverse with a refinance if they're on title. They can sell the house just like in a traditional sale, like have somebody like you list the property, and then they can sell the house, collect the proceeds, meaning the equity that's remaining after taxes and commissions and fees are paid. The last thing they can do, let's say that the house is in another state, the house has fallen in disrepair, mom and dad couldn't keep the house up, and there's no value in it. There's really no gain for them. They don't want anything to do with it. They don't have time. They don't want to touch it. There's too many memories. They can do what's called the deed in lieu of, and they can walk away from it because they're not on the reverse mortgage, but they can deed in lieu of and say, we're done. We don't have any part of this. But here's the silver lining. This is where I usually overcome most objections to a reverse mortgage with the kids. They say, well, you're dipping into the equity. That's true. We're dipping into the equity. And yes, the loan balance grows every single year. That's correct. But mom and dad lived there without having to make a mortgage payment. They could live there to 150 years of age. So that's a real benefit to them. However, here's the benefit to the kids. Not only do the kids get the equity, okay, but all those payments that were deferred over the years where the loan balance is going up, they get to write that off at the time they sell the property because every year when you have a regular mortgage, you get a 1098. You get to write off some of your interest, right? You get a
Right.
standard deduction. Well,
Right.
with a reverse mortgage, because you don't make an interest payment, that just gets added up. But guess what? When you pay it off, now you're paying off all that deferred interest. So if there's $200,000 in deferred interest on that reverse mortgage at the time the heirs sell the property or refinance onto the property, but in short, when that reverse mortgage is paid off, whoever the heirs are, they get to go ahead and write that off now. Now it becomes an itemized deduction versus a standard deduction for that interest.
Okay, so tell me this. All right. So the heir gets the deduction?
That's right. So if they inherit the property, they get the deduction at the time they sell it or pay off that reverse mortgage.
And I realize you're not a tax advisor, so I don't want anyone to
That's
believe
right.
that Michael is giving us tax advice here.
I'm
But
not.
is it a one-time write-off, or is it something you have to amortize over several years? Do you know? Or
No,
does it?
from what I understand, and again, everybody's tax situation is different, but from what I understand, it is a one-time write-off at the time that you pay it off. So in that calendar year, if you pay it off in 2025, that would be when you would go ahead and itemize that, right? And let's say, for example, it's 200,000 and there's three heirs. Well, they're going to take that 200,000 divided by three, and that's what they can itemize in terms of their deduction.
I want to say, I'm going to go over this one more time. So all of us aging adults, I'll
Mhm.
include you in this, okay? We're all
Yep.
aging adults here. So we all would love to leave something for our children.
That's right.
For whatever reason, it's our motherly and fatherly instinct. We want to leave something for our children. Maybe they don't need it, but that's not the point. So we feel, and the children will say, we're losing our inheritance.
Mhm.
If my mom and dad have a reverse mortgage, and every month when they don't make a payment, that interest is added to their loan balance, then
Mhm.
that's eating into their inheritance. So I, as a parent, may not be able to give money to my children because I used it all up. And you, as a
Mhm.
child, may say, hey, I was counting on that. That was going to be my inheritance.
Right.
So how it seems to me you might want to talk about that is that, yes, that's true, but you as a child, as the child of the aging parent, now your mom and dad need help. Right. So
Right.
either if they could afford to make their house payments, they would be doing that. They have a
That's
reverse
right.
mortgage because they have a need. So
That's right.
either you make their house payment for them now, right?
Mhm. Mhm.
And then you get inheritance,
Mhm.
or you don't get inheritance, but you don't have to make their house payment now.
That's right.
Isn't that kind of the point?
That is the point. And sometimes I don't want to say it gets contentious, but you can tell, and you've been in this situation too, Valerie, is that you know when the kids are for mom and dad or when they're for themselves,
Yes.
right? You know it immediately. And it's in our industry, we see it all the time. And the kids that are for mom and dad, they're like, you know what, mom, dad, do what you got to do. We just want you to live a great life and we'll take care of ourselves. Don't worry about it. Right. And then when I explain the equity and the deferred interest piece, that really brightens the conversation. But then there's some kids where, they're like, absolutely, I want every penny I can get out of this house. And at that point, if mom and dad are upside down by $1,200 a month, I turn to them and I say, are you going to cover the $1,200 a month? Because if they get the reverse, that's money back to your mom and dad. But right now, are you going to go ahead and pay them? They said, well, why would I pay them? Well, because what you're advocating for is for mom and dad to continue to pay that, but they can't buy food.
Right. Right.
Right.
Right.
So it's very obvious when the kids are not for mom and dad and they're for
I
their
have a
own.
question. Excuse me, I have a question. So what if my husband and I live in our house and my husband needs to go into a boarding care, assisted living or something, and
Mhm.
we've got equity, we could do a reverse mortgage. All of those things could work. So can I do that with only one of us living in the house?
100%. Yes. Yes, you could. Yes, you could. Yep. Again, you can use those funds if you qualify for a line of credit, meaning the age and the value of the property, and if you're paying off a loan. Because again, that's another myth. Do I have to own my home free and clear? No, you do not. It's a calculation, right? But let's say, for example, everything worked out and you got a line of credit. You can use that line of credit to help pay for the cost of the full-time care community for your spouse.
And isn't it also true? I know I'm skipping around here a lot, but things coming
That's
to my
okay.
mind. Isn't it also true that if I didn't want to use the reverse mortgage, it's just kind of like a safety net that I don't have to borrow against it? I
Yep.
could
That's
continue to
how
make my house payments.
That's right. So I actually think that a reverse mortgage is the best refinance that a senior can get into. If they are really truly worried about legacy and passing on as much equity to the kids as possible, they can always make a payment on a monthly basis. It could be whatever they want to make it, right? That'll maintain that balance at a lower level, or they don't have to make a payment and they can do what they need to do with it. So I say that a reverse mortgage puts a moat around the home, puts a moat around the senior, and it puts a moat around the heirs. Because why? It's a non-recourse mortgage. You're never going to owe more than the value of the property. No one can ever yank you from that house as long as you pay your tax insurance and your HOA. Never take you out of that property. You do have to live in it. It does have to be your owner occupied residence. But again, as long as you meet the terms of the loan, you can live there to 150 years of age without having to pay that mortgage back. That's a lot of security, right?
And let's say one more time for the people who are driving or watching us or listening, that you never have to pay more than the value of your house. Is that
That's
correct?
right. That's right. So if the market goes sideways and the reverse mortgage balance is more than the value of your home, you only have to pay back whatever the value of the house is. That's it. So when you sell it, Valerie lists it and puts a sign in the yard and sells it for 200,000 and the mortgage is worth 400,000, the value or the balance, you're going to pay the $200,000 back and FHA is going to pay the remaining 200,000.
So let's recap a couple things, just summarize. Number one, with
Yeah.
reverse mortgage, you remain on the title. The
That's
government
correct.
doesn't buy your house. They don't own your house.
They do not own your home. Nope.
Never own your home. The bank
Nope.
doesn't own it. Nobody owns it. You own it. Your name's on the loan. You own the house.
That's
Period.
you. Yep.
Okay.
Period.
All right. When the reverse mortgage exceeds the home's value, the borrower doesn't have to pay it back.
Doesn't have to pay back the difference. They only pay back up to the value of the house. That's it. Yes.
Okay. And the bank is never going to take the house away and
No.
take it away. Right.
No. No. Nope. As long as you remain in the property as your owner occupied residence, as long as you pay your taxes and your HOA, no one can yank that property from you.
And the other thing that I hear often is that reverse mortgage are only for people that are desperate. So you shouldn't take a reverse mortgage if you're not really hard up, so to speak. Is that true?
I say if you waited too long, then you might be desperate. If you waited too long, right? Here's the example I give, and most people connect with this.
All right.
If you get into a car accident and then you try and go out and get car insurance, you're not going to get car insurance. If you don't have health insurance and you get whisked off to the emergency room and then you try to get health insurance after the fact, you're not going to get health insurance. So what I like to say is a reverse mortgage, whether you have a line of credit or you just broke even, but you no longer have a mortgage payment, is a form of insurance for a senior. Because again, you don't have to make a payment. If something happens to you medically, whether it's cognitive decline or you have to take a fall, and you are covered. You are covered as long as you continue to pay your taxes and your insurance and your HOA. If you have an HOA, I can't stress this enough. That reverse mortgage puts a moat around you, the property, and your heirs. And we know what a moat is for a castle. That's exactly what it does.
Right. It's your protection. It keeps the bad guys out.
It does.
The enemies.
It does. Yep, it does.
So what are some of the typical uses for a reverse mortgage?
Cash flow, improve cash flow, right? So you get rid of that mortgage payment. That's number one. Number two, to make home improvements so they can age in place. Put in from grab bars to ramps to zero threshold showers, all of it, right? New lighting, just do some remodeling. Lifestyle, right? We like to say that a reverse mortgage is for lifestyle, need, or plan. And the lifestyle would be, you know what? I've always wanted to go on that world cruise. And so I'm going to take $15,000 and I'm going to go on that world cruise. Or, you know what? I would like to see my kids take advantage of some of my legacy while I'm still alive. And it's called gifting with warm hands versus gifting with cold hands.
Oh,
And
tell
so,
us about that.
So what that looks like is, let's say you had a $150,000 line of credit and you said, you know what? I know that my grandkids want to go to a private school. I'm going to gift them $20,000 this year to make sure that that happens. And that when you gift it out of your line of credit, again, you can use it for whatever you want. And again, you're never going to have to make a payment on it, but you can enjoy seeing your grandkids go to a private school or make the down payment for a college, right? Like my middle son, 20, I think he's going to go to UCSD down in San Diego. Okay, my mom could gift him $20,000. What was that?
My son went there. Good school.
Oh, he did? Oh, great. That's great. Yeah. So yeah, so the needs are real. Again, there are no restrictions, but we like to say that it's for a need, a lifestyle, or a plan. The need is I need to improve my cash flow. Lifestyle is, gosh, I'd really like to go buy a car. I'd like to buy a boat. I'd like to go on a vacation. I'd like to play golf every day. That's a lifestyle. A plan is when I work with financial planners, and which is where I get most of my referrals from. And they say, hey, look, Mrs. Smith is 78 years of age. She's dipping into her savings with her assets, $600 a month. She's only got $20,000 left and she's in good health. She's going to run out of that money and then she's going to be upside down every single month. So that's the plan where we get involved with financial planners and we say, okay, how can this reverse mortgage leverage, right, and make her situation better?
And how that would work is then she would stop making a mortgage payment, correct?
Mhm.
So then she
Correct.
wouldn't be that money out of her pocket every month. So it would
That's
take
correct.
that negative away, correct?
That's correct. That's correct. Like, for example, let's talk about my mom real quick. My mom, it's
Okay.
the house I grew up in. She owned it free and clear with my dad. Again, you don't have to own your home free and clear, but my mom did. Well, my mom's age is 78. My dad's age is 88. We know that they're going to base it off my mom's age of 78. Okay. My mom qualified for a reverse mortgage, $300,000 line of credit. Okay. $300,000 line of credit, which means now my mom can tap into that if she wants to do something around the house to repair the home. My dad took a fall. My mom has taken a fall as of the last 6 months. She broke her left femur. That reverse mortgage has proved hugely valuable for her because she had to get some additional things done in the house. So I'm living with it right now. And thank God they have a reverse mortgage, because where would that money come from? It come from the kids, come from us, right? Possibly. But she can do it on her own and she doesn't have to make a payment on it. And no one can ever take that line of credit from her. They'll never say, oh, you know what, the economy's dipping. We're going to take that from you. Oh, guess what? Your value of your home went down. We're going to take that line of credit from you. With a HELOC, that's exactly what they can do to you, and they do it all the time.
So Michael, and here we're in Southern California. You're in Northern California. You have prices, inflation, just like we do. So what happens? Like, how much money can someone get? How high can you get $1 million reverse mortgage?
So in the reverse mortgage space, we call it the MCA, which is the max claim amount. And the max claim amount is $1,209,750. That's nationwide. It doesn't go by county, but that's nationwide. So you can do, yeah, that would be the value would be all the value up to 1.209750. You could get a reverse mortgage. I'll just plug in a number here. But let's just say let's say you had a house that was 1,209,750 was the value. And let's just say you'd been in the house for a long time and you didn't have a mortgage on it. You have zero debt on it and you're 75 years of age. You could get a line of credit for $485,000 on that property.
Great. Great. Michael, I'm so sorry that we are out of time, but we are going to have you back. This was a powerful and eye-opening conversation with Michael Pankow. Our audience, meet Michael. I hope today, Michael not only gave you clarity, but also a sense of possibilities, some things you may not have thought about. At Always Ageless, we aren't here to sell, we're here to serve, to be the voice that you can trust, that you can count on, the resource that you can come back to as you navigate life's most important transitions. So if you found this episode helpful, share it with a friend, a parent. Be sure to come back again next week. And Michael, take a minute to tell us how people can find you.
Thank you, Valerie. And thank you again for being on the show. My honor, truly my honor. The best way to get a hold of me, everybody, is just probably text me or call me, but text is better because, we get so many spam messages now. But my number is 916-296-7765. And that's 916-296-7765.
Michael Pankow, it's been our pleasure. I've known you for a while. I've admired you from afar and respect you immensely. I'm Valerie Van de Zilver. This is Always Ageless, where wisdom meets action. Your next chapter is just getting started. And remember, you're not growing old. It's time to just be bold. Thank you again. See you next week at Always Ageless.